All right. Hi. Welcome back to the continuing lecture in Principles of Finance. For today's class, right, we're going to be talking about the interest rate risk or the maturity risk. Okay. So in our last class, we discussed the strategy to maximize your bond return with the interest rate forecast, right? In other words, you remember this because the interest rate forecast is relatively available. I mean, because at least Federal Reserve is constantly providing guidance as to where the interest rate will be going in the near future, at least in the short run, right? Short run meaning, at 1 year at most. So at least you get the pretty good sense of, where the interest rate will be going. And based on that, you can build your strategy because we know there's an inverse relationship between the interest rate and the bond price. And also, but then interest rate is, although Federal Reserve is constantly trying to keep the interest rate on target, right, through the bond market operation. But sometimes the unexpected events can cause change in interest rates, such as, remember even before March this year, right? Before the explosion of the pandemic, right? Actually, the economy was very good. Economy and the stock market was booming. So the Federal Reserve was actually on the path to raising interest rate. I mean, even early January of 2000, this year, 2020, the Fed funds rate was near like 2.5, 2.75. And then around, as this outbreak of coronavirus in China, and then spreading, steady spread across the world, by March, right? I mean, so slowly, Federal Reserve started to lower the interest rates, and by around March 19th, I guess that was, if I remember correctly, the stock market made a nosedive, right? It just plummeted with a nosedive. And the market lost almost about, like close to 30% in just one day. And then, at that point, the Federal Reserve, accelerated. They really sped up the interest rate drop, interest rate drop. So interest rate is now, from before the early this year, before the outbreak of the pandemic, Fed funds rate was, slowly going down. So it was, near like, 1 point something, 1.5, and then after that it's 0. But think about it. This type of drastic event is totally unpredicted because this is um, this event is, non-economic. It has nothing to do with the economics. I mean, the origin of this crisis is not economic, right? It was, something outside economics. So it had nothing to do with economic fundamentals. The macroeconomic fundamentals were very good, very strong, even until like early January this year, January, February. Uh, so it was totally unrelated to the macroeconomic events. So a sudden drop in interest rate was totally, unexpected. So it couldn't. Usually, all the expected, anticipated events are priced in, meaning it's already reflected in the price. But uh, something ad hoc, right? Something ad hoc like this uh, cannot be priced in, smoothly in the price. But anyway, this is the risk that comes with the uh, uh, interest rate, because the market interest rate is by sudden impact in interest rate, right? It can affect the valuation of our assets, such as bonds. Okay, so first of all, if interest rate goes down, because there's an inverse relationship, valuation goes up. In other words, price goes up. But that also means that if interest rate goes up suddenly interest rate goes up, then also it affects the prices adversely, right? Valuation of assets adversely. Sudden, unexpected increase in interest rate. Now, so that's called interest rate risk, right? And if you remember, going back to our first topic, return on investment, we also discussed a lot about the risks at that point, because bond is basically lending. Ultimately it's lending from the investor's perspective, and it's borrowing from the issuing company's perspective. So remember when we were talking about the cost of capital, right, in the ROI, we talked about the risk premia, because interest rate must reflect um, uh, the risks, right? In other words, if the interest rate is just bare interest rate, right? Um, the investors won't be protected against the risks, and obviously, it's not going to be attractive to the investors. And at the time um, we talked about this, and if you don't remember, just go back to the lecture notes at the time, and that is called studying. Some people just don't study at all. They just think, they just sit in a class, listen to the lecture, and they would understand everything. No, unless you are a genius, and 1%, that would be like 1% of the population. You cannot grasp um, the dimension of what we are doing, right? What you're learning in this class. You cannot grasp the dimension, total dimension of that, and by just listening to the lecture, just just 1 hour, right? And if you think you can, you are just either just completely uh, um, you don't know yourself, simply, right? You don't know what you're capable or incapable of. First, you should know what you're incapable of. That's the You have to have an honest assessment about yourself. If you're not a genius, be frank and honest about it. If you're not a genius, you have to make up for that by tremendous efforts. And what does the effort mean? It means, studying. Studying means going over the topics, going over the material that you don't understand over and over until you understand. It requires a lot of effort, time, and brain. Of course, if you have already the excellent, genius brain, the time and efforts can be, minimal. But if your brain is not, on the level of genius, then you have to compensate for that by tremendous efforts and time. And some people never. I've noticed, I've been a college professor for more than 2 decades, and more than 2 decades, I've seen a lot of students, graduate students and undergrad students, and especially undergrad students are more mature, so they know themselves. They know why they are there and what efforts they have to make. They understand, even if they are, intelligent. It's not just intelligence. It also takes tremendous efforts and time, investment of time into studying to attain the level of, mastery. They are more humble. Graduate students are more mature and they are more humble. They know themselves. They know their limits. They know their limitations. But when it comes to undergrads, especially, lower undergrads, lower class men, what I'm saying, freshmen, sophomores, they don't know their weaknesses or they don't know their limitations. And on top of all that, they are so complacent. In other words, no sense of urgency, no sense of acuteness, no sense of, exigency. They just they're just free floating. A lot of you are just free floating, with no rigorous mind, no rigorous thought patterns, no framework, just, freewheeling and free floating. But a lot of public school system is like that. They never enforce anything on the students. No, they don't hold them accountable to anything. So from, pre-K or, K through 12, a lot of you were just, allowed to free float or free will. Just being, pampered all the time. You've been told all, 12 years of, grade 1 through grade 12. You've been told, everyone is beautiful in their own way. But you've never been told that you have to make sacrifices and work hard to get ahead. So nobody, and this is a very straightforward, honest function, right? Studying is a honest, straightforward function. If you invest 100% of your time and efforts, your reward, it is, shown in the reward. You get A's or you get, higher grades. You invest in 110%, 120% of your time, yourself, your, blood, sweat, and tears. It will never fail you. You get rewarded by, high grades, But you just don't know. You just don't look back on the lecture. I mean, the lecture note it's provided all the time. It's online. Yeah, on the blackboard, it's always there. But some students say, "Oh, I'm not understanding it." Some students tell me, "Professor, I'm not understanding it." Then what does that tell about you? It simply means either one of the two things. You're not studying or you're not intelligent enough. If you're not intelligent enough, you got to make more efforts. You got to invest more of yourself into it until you understand. You cannot simply say, I'm not understanding it. So what? What am I supposed to do about it? You are supposed to do something about it, not me. You understand? Huh? You are supposed to, if you don't understand it, you must go back to the lecture notes, to the videos, and I made videos available 48 hours. Why don't you revisit it? And the lecture notes are there permanently and until the end of the semester. Revisit it and study. Studying means cracking your shell. Your cranium is a hard shell. If you don't understand, but you don't read it at all, and then you don't understand. You don't study at all, you don't understand. You got to revisit the lecture notes and crack that hard shell of your cranium and put that into your brain. That's something only you can do to yourself. Nobody else can do it to you. And it's only natural, I mean, um, not everybody has the same intelligence, right? There's a distribution of intelligence. There's some people are very smart, some people are not. And you got to know yourself where you belong on that scale, where you fall. You got to know that. If you just keep saying, "Oh, I'm not understanding it," what does that tell about you? What, right? What does that tell? As I said, it just means one of the two things. So before saying too soon, I'm not understanding it, ask yourself, did you revisit the past lecture notes and study until you understand? Did you really go over it over and over and over and over until you crack that hard shell of your cranium and you know um, metaphorical. This is of course metaphorical, um, figurative expression. But did you ever try to do that? Huh? Did you ever go over the lecture notes until it made sense to you? Did you ever, read the book until it made sense to you? Did you ever researched online for related material and further information about it until that made sense to you? That's why I'm saying it takes tremendous efforts and tremendous investment of effort and time. All through all through that public school, in the US the public school system K through 12 is a joke compared to other countries. And you think, having come through that system of joke, you think you are. This is simply a matter of self-discipline and rigor, regimented, disciplined lifestyle and habit. People who are successful are extremely disciplined. You understand that? Self-discipline, right? They know what to do, what not to do. They know how much sacrifice they have to make to achieve the goal. And this is not the reason, the time that we should spend on today's lecture, but because to understand, if you don't understand today's lecture, then I'm telling you to go back to the past ones, right? Because everything is up to today, it's all building up. It's yesterday's, we are building up. This is like compounding. We're building up on day one lecture. I mean, day two lecture is, built upon day one lecture. Day three lecture is built upon day two lecture, which is built upon day one lecture, and so on. So if you missed all those day two, day three, day four, I mean, all the way up to this point, and this is why it is important to be present at every class. And this is also why I've been telling you, if you miss 6 classes, 6 sessions, there's no way you can make up on your own. And some people are still, there are people who have made, I mean, you can see, I'm posting the test results with the attendance, and all those red, right? Red lines. What does that mean? People who have made more than 6 absences. Throughout this semester, we've had like, how many sessions? 16, 17, I don't know how many sessions we've made. But there are people who have made almost, made, like 12 absences out of 16 sessions, and email me just one day, Professor, can I still, make up, how can you make up? Do you think this is like a history class or philosophy class or English literature class? You think you can just read up and you can make up on your own? I've been telling you from the day one, this class is fundamentally different from those subjects. Though in those subjects, you can miss a chunk of semester. You can miss the chunk of the semester. But you can read up. Yeah, you just go back to the reading material and you read up, and you can catch up and you can write up something. But I've been telling you from the day one in this class, that's fundamentally impossible. This is not something you can read up and make up. If you have missed the whole lecture about the time value of money, there's no way you can take midterm. You understand? Huh? You should understand. You should know that. Because I've been telling you from the day one, this class is very highly technical and highly quantitative, right? It requires a lot of mathematical reasoning. But if you have missed all those, sessions, then you have no way of doing that mathematical reasoning. And people cannot, simply, if you don't do your diligence, if you're not strict to yourself, if you're not disciplined, if you don't have regimented lifestyle or regimented, at least regimented thinking, it's just culture, personal culture. Your personal culture should be regimented and disciplined. If you're just lax, laid back and lax, of course you can be laid back at times, but when you have to do, this is a task that you have to accomplish. Without it, you don't get the grade. You don't get the sufficiently decent grade, right? And the decent grade, the grade is the straightforward, honest response to your own efforts and your own merits. So I'm not gonna, this is not the reason, for this, but for this class. But if you think you don't understand, having a hard time understanding it, you got to go back to the past lecture notes and videos, okay? And don't waste that 48-hour window for the video. You can repeat the video over and over. At least that's the upside of the distance learning. I mean, if we are in classroom face to face, once my lecture is over, class is over, it's gone. There's no way to repeat it unless you record the lecture. Well, anyway, knowing that there is a risk is in back to return on investment. As we were talking about the risks, there were four types of risks. Remember that? First of all, the most obvious risk is the default risk. Isn't it right? When you are lending money, the default risk is the most obvious risk. Second, there is inflation risk. Remember that? Inflation. And I told you, inflation risk is coming from the macroeconomic system, right? So it's not default risk is specific to the individual borrower, right? Specific to the company, but inflation is across the board. It's through across the entire economy. So it's coming from the macroeconomic source, right? It's the risk coming from the macroeconomic source. And then third, maturity risk. Third one, in the order we did it in the first topic was the liquidity risk, but more than liquidity risk, maturity risk was very important. The fourth one was, maturity risk, and I told you at the time, I explained it as, it's the risk associated with the maturity, because the longer the maturity, right, the more uncertain it's going to be, because the longer into the future, the uncertainty increases. Nobody can predict, precisely for the long run horizon, right? Most forecasts are relatively, I've been telling you, relatively more accurate for the short run horizon, like under 1 year. But as the time horizon increases, right, the forecast becomes less and less accurate, right? So there's more and more uncertainty as the timeline increases, and that's why that's the risk associated with the maturity. And at the time, that was the only way I could explain it. Because at the time, you guys didn't know what the time value of money is. But then maturity risk is also called now we can associate it with the time value. Maturity risk is also called interest rate risk. Why? Think about it. The longer the time horizon, there are more chances of unexpected change in unexpected change in interest rate, right? Beyond actually 1 year, it's really hard to tell where the interest rate is going to be headed, or other variables as well, what the inflation is going to be, So think about it. The longer the horizon, in other words, the maturity, right? There are chances that interest rate may suddenly, go up, right? And this is why it is. And if interest rate goes up, what's going to happen to the price of the bond? Your bond holdings, any stocks or bonds, anything. When interest rate goes up, the valuation goes down, right? Now you understand this because we've done time value of money. Because the discount rate, right? The discount rate goes down. If the interest rate goes up, this discount rate goes up, and as the discount rate goes up, the valuation goes down, right? And vice versa. If the interest rate goes down, the valuation goes up. Now, so currently, uh, uh, you know, the Fed funds rate is almost close to zero again. So then valuation is relatively, benefiting from that. But, uh, just because valuation is benefiting from low interest rate, right, doesn't mean that, that could be a one reason more people would put their money into the stocks and bonds, which would also explain why the stock market is, uh, uh, totally disconnected with the economy, right? Because people, if you nobody will keep their money in the bank. I mean, in times like this, you would hunker down, and some people would hold on to uh, the cash holdings, but uh, this is very uh, precarious situation. So they would put their money into uh, gold, commodities like gold, because gold will usually, when there is inflation, uh, gold is, the instrument. Uh, yeah, but anyway, when think about it, if you're holding everything in cash, the downside is there's no return. So the market participants will try to um, put their money into something that gives, the return, and on a steady base. So the bond is then, preferred. But once again, bond yield these days, because uh, unless the bond yield will go down if you more investors put their money into the bond, and this is where people. This is a time where people put their money into like treasury, because treasury is the safest. But then as the price goes up, you put your money into treasury, price goes up, the return goes down, right? So that's why the maturity risk is also called interest rate risk. So here's the empirical example of the see. Let's take a look at the impact of coupon rate on price, and the impact of maturity on price. First of all, if the coupon rate is 0%, 5%, 7, 10, right? And on 30-year bond, 30-year is, very long term, so fairly long term. And what's gonna happen to the valuation when uh, the market interest rate, not the coupon rate, right? Market interest rate, which is being used as the discount rate, when market rate goes up from 6 to 7%. Look, uh, if it is zero coupon, right, at the discount rate of 6%, or the prevailing market rate of 6%, um, 30-year, zero coupon will sell. The market price should be this. It will be like 169. So it is sold at very deep discount, right? 6%. If it goes up to, the prevailing market rate goes up to 7%, it's just 1% increase. Then it goes down to 126. So the change is negative 25%. Now, as the coupon rate increases, if the coupon rate is 10%, um, and at 6% prevailing market rate, we can already tell this is going to be a premium bond, isn't that right? We can tell already it's a premium bond. Yes, it's 1.5, 1,500. And then at 7% discount rate, it's still a premium bond because 10% is much better than 7%, right? But the drop in the price is negative 11%, right? So you see, interest rate change will have, especially if interest rate goes up, will have a negative impact on its price. So it's also called price risk. Okay, so uh, it goes by three different names at least. Maturity risk, interest rate risk, because the longer the maturity, there are more chances that the interest rate would fluctuate, right? And then three is called, price risk because the price will fluctuate as well. Now, and the impact of time to maturity, right? Time to maturity on impact of maturity on price. So let's assume same coupon rate, but different uh, time left to maturity. 20 years, 10 years, 2 years, right? And then if the discount rate is 6% and it goes up to 7%, right? If it goes up to 7%. And of course, you can tell this is going to be a discount bond to begin with. Why? Because the coupon rate is lower than you see, coupon rate is lower than the discount rate. So it's bound to be a discount bond. So at 6% prevailing market rate, um, 20 years, no, 20-year bond will be, the price at 884, but at 7%, 786. So the change or the drop is 11%, negative 11%, right? Change is negative 11%, drop is 11%. 10 years, no, you see 925, but at 7%, 870, 850. So 7% drop, 5 years, 4% drop, 2 years, 1.8% drop. So the also depending on the maturity, right? What the impact of the change in prevailing market rate is also significant. The longer the maturity is, hence called the maturity risk, right? So having this in mind, right? Maturity risk is revisited. So also known as price risk and interest rate risk. Long-term bond prices fluctuate more in response to change in rates than shorter-term bonds. Yes, you saw that. I was talking about this, right? Long-term has more impact, and especially long-term bonds with low coupon rate. Of course, if you have a higher coupon rate, the impact is mitigated. But low coupon rate, uh, the you get more, you get blown, you get a big blow, right? You get really you suffer a lot, right? You get beaten up really badly. Short-term bonds with high coupon rate, you suffer the least, right? High interest rate risk bond experience. Of course, if the bond has high interest rate risk, there will be considerable capital loss when rates go up, right? Yeah. So here's another example of a change in price at different terms due to increase in interest rate from 8 to 10%. So as you read the table, right, you can see how the severe the impact is. So maturity risk uh, graphically represented, right? It's simply because, look, what this is showing you is how, a 25-year bond, of course, if you hold it to maturity, you get 1,000. But if today is, year 15, right? Of course, because of the discount, right? Um, and then another risk that it wasn't discussed at the beginning, of the semester, ROI, when we were talking about ROI, we didn't have chance to talk about the reinvestment rate risk because the four risks at the time was, simply default risk, inflation risk, and liquidity risk, and maturity risk, or interest rate risk. But then there is also reinvestment rate risk because um, think about it. We've been assuming all along. We are assuming that if you receive if you receive interest from the bond or dividend from the stock, um, just let's assume you're receiving interest on the bond. We've been assuming that you can reinvest it at the same cost of capital. In other words, you can reinvest it in the same bond. And if you reinvest it in the same bond, then it will still earn the same coupon rate, right? Uh, but then this will not be the case, right? When interest rate fluctuates. Uh, Now, first of all, here's another thing. Here's one example. I mean, this is not the only example of reinvestment rate risk. So suppose interest rate went down, right? You are holding uh, a bond. Uh, but let's assume a callable bond. I mean, it applies to both um, non-callable as well as callable bonds. But if we assume callable bond, it will be more. The example will be more uh, striking. Suppose you have callable bonds you're holding, and it has still it's a 20-year bond, and now it is at time today is time 10, year 10, right? We are at end of year 10 at this point. Um, so we still have 10 years left, but the bond is called. The bond has been just called. So you have to surrender the bond, although you will get $1,000 face value plus uh, uh, one more year coupon interest as the call premium, right? So you have, suppose you have $1,100. Interest rate went down. Although you have $1,100, uh, uh, the fact that your call premium was 100 means this bond was paying 10% coupon, right? But now think about it. Overall, they call the bonds because the overall interest rate in the market has gone down. So the company can now sell new bonds at, let's say, 5% coupon, right? Or even lower. I mean, overall interest rate in the market is, let's say, average market rate is, let's say, 3%. Now, then, what does that mean? On average, what is your reinvestment return? Return on your reinvestment. I mean, in other words, on average, you will get 3%. Makes sense because average return is now 3%. Average, on average, you will earn 3%. Well, you got your money back, 1,100. but this can no longer be reinvested at 10% anymore, because that rate. This is one thing, one example of reinvestment rate risk, but on other examples. So future interest chances that the future interest payments will have to be reinvested at a lower rate. Price goes down. Price drop is greater for bonds with lower coupon rate. Yeah, when rate goes up, right? Interest rate goes up, price falls, and this is greater. The price drop is greater for bonds with lower coupon rate, and because of the reinvestment rate risk, because uh, so let's look into this. If the interest rate goes up, bondholders' cash flows are discounted at higher rate, right? So it lowers the bond value, right? And since cash flows from low um, coupon bonds are smaller, right? Bondholders will have less money available from interest payments to buy new higher coupon bonds. Yeah, with smaller, right? You got your money back. I mean, you sold. I mean, if it is a callable bond, you got your money back. If it is not the callable bond, if it is not callable bond, you still have your money in the locked up in the bond, right? But then with the smaller coupon is small, right? Coupon payment is small, and with higher discount rate, your bond valuation goes down, including the smaller coupon value, right? So you have less money. If you sell these bonds now, you have less money available, right? To put into anything. So this is a dilemma, right? So holders of lower coupon bonds have their capital tied up in assets that are not making them as much money, right? So then this dilemma is what? Uh, you cannot sell, because if you sell, you will just realize smaller cash payment, right? With greater capital loss. And then with the smaller proceeds, you have to buy new bonds. And this is, also the same thing, bond or stock. You face the same, dilemma. When the bond, your stock, and when your stock drops, uh, usually, you gotta cut loss, sell and cut loss. But if you miss that timing, uh, if you sell, you just simply realize uh, significant loss. Sometimes you cannot even recover 50%, or even 20%. And when you then with that proceeds, you cannot recover. You cannot buy back any. You can buy back, but um, your equity holding, your stock holding or bond holding will be much smaller, especially in times of high coupon rate, high interest rate. In times of high interest rates, the valuation is relatively suffering. So um, with the smaller funds, you have very little choice of uh, stocks or bonds to buy. I mean, you can still buy, but uh, with very high interest rate, right? The stock market will be depressed, uh, even if you invest. Also, bond market will be you have to buy high coupon bonds, but even if you buy them, the price doesn't go up that easily because valuation is already depressed. Now, so this is the dilemma, right? You are you going to sell, and if you sell, you realize a big loss, right? And if you so you are afraid to sell, you hold on to it. The longer you hold on to it, the lower the valuation, right? As long as the strong interest rate is depressing the price. Uh, so this is a dilemma, right? We're facing that dilemma. So either way, lose money, right? Relative to bondholders with uh, higher coupon rate, right? If you're losing money relative to bondholders with high coupon rate, so you might say, oh, then why didn't you in the first place? Why didn't you invest in high coupon bonds? But look, don't you understand if what there's a what kind of bond is paying higher coupon of bonds? Remember, the higher the risk, the higher the coupon rate. Makes sense? Um, in other words, high quality bonds, right? In other words, high credit rating. Why high credit rating? Due to low default risk. Those bonds with high credit rating, so AAA, double A, single A, these bonds don't pay high coupon. Make sense? But the bonds that pay high coupons are the very risky bonds. I've been telling you, fallen angels, triple B, I mean, a double B, single B, fallen angels, or triple C, and that brings us back to right. I showed you this table before. Um, high, so bonds in this lower ratings, they pay high coupon, but they are very risky. See, low single B, low quality risky, and triple C, low quality possible default, right? Double C, it may low quality, it may default, but recovery is possible. Single C, defaulted, it has already defaulted, and the recovery is unlikely, right? And they are generally called junk bonds, right? Uh, you know, uh, they're generally called junk bonds, right? These are called, fallen angels, but overall, below triple B, generally called junk bonds. And I've been telling you, junk bond sounds very derogatory, right? But that doesn't necessarily mean they are bad. They just are very risky. On the other hand, they pay very high return, so they are just simply as risky as the stock, right? Something like triple C, uh, double C, typical example of junk bond, right? And that brings us to I also talked about this before. Uh, Bond rating agencies. There are globally renowned, three rating agencies that are globally renowned: Moody's, S&P, Fitch, IBC. And I've been telling you, Moody's and S&P are U.S. based rating agencies. Fitch IBC is British, I believe. Let me. Oh, you may not see this, but if you click on that, that will take you to their website. Okay, so now then that brings us to the yield curve differentials, and we already know what yield curve is. We discussed it, in the first topic, right? But the low quality, the yield between high quality bond and low quality bonds are relatively steady, right? Differential between high and low quality bonds, right? Yields are relatively steady. So that and I talked about the difference, the yield differential between 10-year Treasury and like 3 months Treasury bill, right? 10-year Treasury note, the difference between 10-year Treasury note and 3-month Treasury bill, the yield differential is usually used as the indicator of um, uh, the recession forecast, right? Why? Because 3-year um, oh so another story, because this is that's long term and short term, and this one is high quality bond and low quality bond, uh, uh, and this difference can be used generally as the risk premium, right? Risk premium between the risk premium to make adjustment to uh, the cost of equity, right? In other words, to find the required return uh, in a very crude way, required return for or the discount rate for stocks in a very crude way. Uh, they use this uh, differential as the risk premium for. But that's because it's a crude way. We're not gonna actually use it. We're gonna because for stocks we're gonna be using more uh, sophisticated risk adjustment techniques. So that wraps up everything about the bond. So this is we have a few more slides, but that's not for this class. It's not really necessary to go into this. This wraps up everything about the bonds. So now I want you to. We're gonna start on a new. We're gonna set foot on a new topic today, which is risk and return. So as a preparation for that topic, we're gonna actually do something to calculate risk and return. So we need the data. So let me go back to okay, let's go back to I will stop this PowerPoint, and I'll go back to let me go back to Okay, let me share. Okay, let me share my screen, right? So I'm going to be sharing. I don't know if this is what you can see, but let's see. Oh, this is not right. How do I select only one? Okay, so how do I share my screen? So I want you to go to Yahoo Finance, and let's see if I can try this again. Oh, okay, I can do this, I believe. All right, so is this what you see now? Yahoo Finance. Okay, Yahoo Finance. Let me make sure that's what you can see. Yeah, all right. So if you're on Yahoo, go to Yahoo Finance and let's look up Apple. Okay, Apple. Apple's ticker symbol is AAPL. I mean, you don't need to know the ticker symbol these days, but even in early 19 mid late 1990s, you had to enter only the ticker symbol in the search window. Apple's ticker symbol is AAPL. These days, if you just type in Apple, it's going to come up, right? Uh, so we want to look up Apple's data. Okay, so here, so I got Apple, right? So Apple, as of yesterday, Friday, April 17th, at the closing of the market, right, 4 p.m., Apple was 282, and it looks like Apple, had a bad day. But look, this is just intraday, what they call intraday transaction record. We need to look at for example, it was only from 10 a.m. through like 9:30 a.m. through. So if you select 5 years, right? If you select the time horizon, right? Over the last 5 years, it's been doing okay, right? And obviously, this means this was like March something, right? March 19th, or around the time. And but all this is totally unnecessary. I mean, we can actually look at the chart, and uh, we can look at daily movement, right? Price actions, right? But this is not what we're interested in. What we are interested in is the actual data. So we go to the data, historical data. Okay, you click on that, and then what do? We want to look at the past 5 years. So select, right? April. I think I better do, we will need one more. Uh, we will need one more data point. So we're going to go to 2000. Oh no. 5 years back, like 2015. We can start from March. That's fine. And click done. And we need monthly price. Daily, we don't, it's too much fluctuation. So we'll select monthly and hit apply. And you will see it's monthly price that you see, today is April 17th. I mean, the day, this is not the day you are watching this video. This is the day I'm recording this video. And you have some people were, this is just the common sense. If you are sensible, it's obvious, right? This doesn't need to be explained. But some people, there was a student who was asking me on the, who was arguing, trying to argue with me. I cannot see, blah, blah, in the discussion board, uh, um, well, where's your thread, My thread was there, in the discussion forum, and the thread was, it says today's lecture, and it was dated, not as of that date, but some prior dates. But then the student was saying that was not today's lecture. But where are you in now? You're in today's forum, right? No matter what the timestamp on that lecture, my thread, no matter what the date of the timestamp is, as long as you're in today's forum, then that's today's lecture. Something like this, even a very basic things on a common sense level. If you're being that's a nonsense. If you're arguing about the timestamp on uh, that a discussion thread, because I'm pre-recording this video and post it for a target date, then isn't it obvious? No matter. So here, we got April 1st, but this is not really the April. Okay, this is April 1st, but March 1st. This is not March 1st. This is actually end of March. Okay, why? It's just the way for April. April isn't over yet, so April 17th transaction is there. But when April is over, actually the last day, transaction of the last day will be timestamped as April 1st. This is just the way the date is recorded, right? This is just the way the timestamp is put on the data. Look, this is the monthly data. And think about it. What would be what do you think is the price that represents the price of the month? Huh? The price of the day's trading, price of the day's trading. I mean, there are 4 price points, right? Beginning, closing, high, low. Which one is the price that marks that day? That's the closing of the market. Isn't that right? No matter where the market opened, no matter how high it reached during the day's trading, no matter how low it went down during the day's trading, it doesn't matter. The conclusion of the day is always the closing price of the day. Make sense? Closing price. So we are dealing with the monthly data. So on although the timestamp is February 1st, this price represents the closing price, close of the end of the month, right? Of course, we have close, open, high. So this means, high opening of the month, the highest of the month, right? Lowest of the month, closing. And then there is, adjusted closing price. You also see dividends paid, right? And I've been telling you, dividends are paid uh, in the following quarter, right? You cannot pay the dividend of the fourth quarter as the fourth quarter ends. Make sense? And this is something I already explained in class. I don't want to go over it again because we are, um, we don't have, a luxury of time. But at least I want you to do one thing. We need to download this data. But before we download this data, because the way it is now, it is just on the web page and there's nothing you can do. You cannot do something to the data that's on the web page. So we will have to download it to a spreadsheet, right? We'll do that shortly. But what did I say? Um, December has to end, right? Fourth quarter 2019 has to end. And after the end of the fourth quarter, they will compile the data, right? And then uh, they will report earnings around the second week of the first month. I mean, as early as the second week of the first month of the following quarter. So in January, they reported earnings, right? Earnings per share, earning EAT, earnings data. And in the second month of the following quarter, they pay out dividends from the previous quarter. So here, November dividend is actually the dividend from the third quarter. Makes sense? And the dividend, theoretically, dividend is tied to the EAT, right? Earnings per share. So it would change with the earnings per share, but in reality, they just pay out fixed amount. Anyway, so how do I download this? Well, you see here, download data. So click that. It's gonna, right? So it's been downloaded. So you open it. This is how it looks, but I'm going to first of all, the way the number is expressed, you're not, familiar with this. And this font, this is the default font, a Calibri size 11. I don't like that. I mean, personally, you may like it, but this is not uh, user friendly or vision friendly. For me, it's not vision friendly. And if the numerical data is presented this way, this easily, makes people lose interest in the numerical data. So the first thing I do is I'm gonna treat the data, right? I'm gonna need the dough, right? I'm gonna treat the data in the best way. So I highlight the entire spreadsheet. You just saw what I did. Click on this, right? Click on this corner. Entire spreadsheet is highlighted, and I can change the font face to something I like. I like, Bakersfield. I want to increase the font size to Oh no, that's decreasing. Something like 12. This is decent. And when you double click, when the entire spreadsheet is highlighted, double click on them, double click, it's going to expand everything. Now, although this is the, we have a lot of, so I'm going to, we have multiple columns, but we need only one column, two columns only, actually. So first I'm going to label, I'm going to put a label. I'm going to bold, put a bold and underline and center line the labels. And I'm going to, first, I'm going to sort it in descending order. Okay, sort it descending. So the most recent will come on top. And then I'm going to copy the entire data set and open another sheet and paste it there, because I'm going to leave the original data set as it is, and I'm going to then only, first of all, I'm going to, as I said, I'm going to need only, two columns, first date column and the price that represents the month is always, any trading, right, period is the closing, right? So I don't need the others. So I'm going to select those columns and delete those columns. And then volume is not necessary. It's not needed for now. So I'm going to delete that. And between, what is this? Close, adjusted close? They seem awfully, they seem like, what's the difference? But here's the difference. Look, when they made dividend, a dividend isn't shown here, but when they made dividend payments in February, close and adjusted close prices are different. November, right? They made it's different. So what is this? Adjusted close price is, you will see. Oh, I'm sorry. You were probably all this time. You don't see this, right? So I'm going to go back to oh, okay, the whole thing. I'm going to have to go back and okay. So let me go back to all right, this is what I'm talking about. So I downloaded the data, right? And then by, selecting, by clicking on this, I select the entire spreadsheet, and then I change the font, right? Okay, which means, while the entire work spreadsheet was selected, I clicked on, I changed the font to what I like, and then center line these, labels and underscored these labels, and so on, underline these labels. And then I sorted also, this is, in ascending order, but I sorted it into a descending order because I want the most recent price to come on top. So I sorted, right? And then after that, I highlighted the entire data set and also pasted it on the second sheet, right? Second spreadsheet. And from there, because I don't need these three columns at this point, delete it. I don't need volume at this point, I delete it. And then I was just about to explain what is, close and adjusted. Adjusted close price. I mean, if you go back to Excel file, you will see what it. If you go back to the Yahoo Finance, there is an explanation about adjusted close. Adjusted close is the basically price adjusted for stock splits and dividends. Okay, so I'm gonna go. We're almost out of time, so I'm gonna have to explain the difference in the next class. But as long as you have come to this point, right? That's fine. That's good. As long as you have come to this point, you're okay. And I'm gonna change this label to PT. No. I'm gonna do that next time. So actually, the data we're gonna use is adjusted close. Okay, so that will be our discussion in our next class. Okay, so that's it for today. Okay, end of video. And if you also downloaded this data from Apple as we went along, please save the file. Don't leave it unattended, right? Save the file. I'm going to save this file. I'm going to give it, okay, save as. First of all, make sure it is currently not Excel file. It's only opened in Excel file, but it is CSV file. Save it as Excel workbook, okay? So change that, and I'll call it, name it Apple 20, okay? 20S, Apple 20S. Okay? Yeah, save. All right, so we'll continue to work on this file in the next class. Okay. Thanks for watching. End of video.